Hi, everybody. Welcome back to another YouTube channel video from Streetlight Financial. Today we have Brad Murphy, who is the Regional Sales Director for Morningstar Investment Services. We're recording this on April 10th. Murph, thanks for taking the time. I really do appreciate it.
Thanks for having me, Aaron. I'm happy to be here.
So we have many clients that have Morningstar portfolios, portfolios that are dedicated to your service and your firm and under your guidance. But also this video will be viewed by the general public as well. So we're going to give some timely market updates at this time and stuff. So hey, first off, I'd like for you to describe Morningstar as a company and your company structure and things, if you would.
Sure. Okay. Thanks, Aaron. And yeah, so Morningstar Incorporated was founded in the 1980s primarily as a mutual fund research company. We've branched out over the years to provide research on all types of securities so that today, in many ways, Morningstar is the industry leader when it comes to independent securities research. But importantly, we've had really one goal since our founding, and that's been to help people make more informed decisions about what to do with their investments. So many financial advisors and individual investors will use our research to help them pick investments. And then by extension, who I work for, Morningstar Investment Services, we specialize in building and managing portfolios for financial advisors and their clients. And it's in the same spirit. The idea here is that you can tap into our expertise and everything that we do from a research standpoint to build portfolios that are designed to help you help your clients reach their investment goals.
Sounds good. So, yeah, I mean, we run Morningstar reports for clients that are just completely independent that would have, investment research on whatever securities they have, and then your specific and managed portfolio division we use quite a bit. I mean, one of the biggest providers of portfolio design and oversight that we have. So, Brad, thanks for that. Just, if you wouldn't mind describing what's happened year to date so far in the financial markets, in your view, in 2020.
Sure. So it's been a pretty wild ride, right? Here we are on April 10th, and it's pretty amazing. Things have, even in the past few days, changed a lot. So actually, I was reading this morning that the S&P 500 was up a little over 12% this past 4 days, making it the best week for the S&P 500 since 1974, which is pretty remarkable when you think about it. But a lot has happened before that, of course. Number one, I think it's important for people to keep in perspective that as of mid-February, the market was actually up quite a bit year to date. At that point, the S&P 500 was up maybe a little over 4%, and the NASDAQ was actually up higher. That's on top of what happened in 2019 when we had one of the best years ever for the markets. And so I think it's important for investors to keep that in perspective. Things had been going quite well, and we had been having a bull market for quite a long time. Of course, once the virus really started to take hold in late February, investors really recalibrated what they thought was going to happen with the economy. And so at first, as it started to move into Europe, it started to become apparent that global supply lines and movement of people was going to go down to a significant degree, and that caused the market to go down. And then as we moved into March and it became apparent that this was going to be a big deal in the United States and really all across the world, the realization came into play that this was potentially going to have a severe impact on the overall economy, and that I think most people would agree at a minimum there was going to be a mild recession and perhaps even a severe recession. And this caused people to reprice the market to reflect that reality. Now, in many ways, looking back now, it seems as if there may have been, a bit of a panic scenario. There was, a couple of weeks there where certainly people were panicking about the virus itself and probably panicking about the markets as well. And, it's not really that surprising. Think about the amount of uncertainty that there was in mid-March, both surrounding the virus as well as the economic impact. And so the market sold off over 30%, and it was only the 9th time that that's happened in the last 100 years. And so it was a very sharp and fast pullback in the market And obviously that was very painful. Now, since then, the market has really repriced itself again. We've had, number one, the effects of the response, which has been both the monetary response from the Federal Reserve as well as other central banks. We've had the fiscal response by our government, and we've also had a bit of a clearer picture on exactly what's going to happen with the virus. And so now the market is really pricing in more of an optimistic scenario. And it's, to be honest, a bit surprising given how fast things have changed. And so we've gone from really a panic scenario to a scenario right now, as of where we stand today, with the markets being closed for the Good Friday holiday, where the market's now starting to price in a little bit more of an optimistic scenario, which would be, yes, we're probably going to have a recession. The virus is certainly bad, but that perhaps we are actually flattening the curve, and that maybe we will get past this. So that's where we are right now, and it will be interesting to see where we go from here once we start to get more of the economic data, because it's likely that the data is going to be pretty bad. And so it will be interesting to see how the market responds to that over the next few weeks, because I think we're looking at, still the reality of there being certainly some kind of recession and potentially a fairly severe one.
Right. So thank you for that. That was very thorough, and I think it really does speak to, more than just a quarterly statement and what's happened in their portfolios. What's actually attributing to that movement. So what would you say to an investor who's concerned? Like they're getting their quarterly statements now, March 31st, as the quarter closes out, and they may be retiring relatively soon or might not. But what would you say to concerned investors at this point?
Sure. Yeah. And even after this little mini rally that we've had, a lot of it's happened after April 1st. So March 31st statements are certainly going to be ugly, and it's going to be painful for a lot of people, especially retirees. I think the number one thing that people can do right now, and the number one thing that we can encourage people to do, is to lengthen their time horizon beyond what's happening right now. And I think maybe we've even done that a little bit already. But, if you think just a couple of weeks ago, the time horizon got shortened to day in terms of, the changes in the news and in the development of the virus and changes in what was happening with the market. And so it was almost impossible to lengthen your time horizon beyond the current day or perhaps week. I think, again, the best thing that we can do is look out 5 years. And if you're a long-term investor, you certainly are going to be investing for 5 years. And, ask yourself, do you think the stock market is going to be higher 5 years from now than it is today? And I think the answer is almost 100% yes. And so if we can do that, if we can lengthen our time horizon, we can make more clear and I guess more or less emotional decisions about what to do with our investments. And so for most of us, not everybody, but for most of us, it's going to make sense to stay the course. And that doesn't mean doing nothing. And I think that's the benefit of having a managed account like the ones that we offer at Morningstar, is that we're certainly going to be rebalancing people's portfolios where appropriate, and also looking for opportunities to invest in some of these asset classes that are really beaten down. And so for those that are staying the course, you can know that there are actions you can take to improve your portfolio. But for most of us, it's going to be beneficial if we just simply lengthen our time horizon to gain a little bit more perspective on where we are and what's likely to happen in the future.
Right. Yeah. Nice pivot there, because the next question was, I've fielded more opportunistic calls from investors than freak out calls, quite frankly. Yep. It's a testament to the folks that we serve are looking for that, that next opportunistic or getting in at the right time, and they know to buy in when the market sells off. Any advice to someone looking for an opportunistic view and putting money to work?
Yeah. So, again, a lot has changed over the last week and a half or so. We're certainly probably not at the kind of entry point that we were, say around March, 22nd or so when we, hit the current market bottom. But again, the number one advice I would have is that it's impossible to time the market. Nobody can do it. And, even, where things change so much day to day right now, you don't want to miss that, best day. So the worst thing that you can do is try to get out and then get back in. That just simply does not work. But for investors that have a long time horizon, again, if you are smart enough to be able to lengthen your time horizon out 5 years and realize that stocks are likely to be higher in the long term, realize that you're not going to be able to time the bottom, but that you're at least able to buy investments at prices that are probably cheaper than they were before, then that does represent a pretty good investment opportunity. And I think that's certainly the case when we're in a position where the market is sold off over 30%, which is where we were just a couple of weeks ago. Probably not as good of an opportunity right now where we are on April 10th, but there's every possibility that the market does retest the lows as the economic data becomes worse. And, anytime the market is selling at prices less than they were before, that typically represents an opportunity for more gain in the long term and perhaps even less risk in the short term if you're able to buy investments at really cheap prices with a margin of safety. And so, for anybody who's a long-term investor, I would see, all of this as an opportunity to buy investments at prices that are certainly cheaper than they were back in January, and that probably represent good long-term investment opportunities with the knowledge that you're not going to be able to time the thing perfectly.
Got it. So as you know, and I appreciate your partnership for the number of years we've been working together to serve our mutual clients, I'm quite difficult to deal with sometimes because, I'm looking out, I'm looking out for the bet, for our clients. And I expect a lot of the investment managers that we partner with to manage money. I expect, I have a very high expectation of you guys. So specific to Morningstar portfolios, how were you positioned going into this coronavirus crisis, and where does it stand now, and where do you think Morningstar goes from here inside of the specifically your portfolios?
Okay, sure. Yeah, that's a great question. At Morningstar, we are valuation-driven investors, and what that means is that we want to invest in securities, stocks, and bonds when they are selling at prices below what they are worth. And so there's a quote from Warren Buffett that price is what you pay, value is what you get. Most people think of where the Dow Jones closed yesterday as being the value of the market, when in reality that's the price of the market, and it doesn't necessarily reflect the value. And so what we want to do is emphasize investments that we think are selling at prices below fair value. Coming into this crisis, we did see a lot of investments in the world being relatively expensive or overpriced in comparison to what they were actually worth. And so we were relatively conservatively positioned going into this. We were holding cash in a lot of our portfolios, and that did help us on the downside in, when the market was initially selling off very quickly in late February and the first half of March. Since then, the first thing that we've looked to do is to simply rebalance our portfolios. So as stocks sell off, you're going to own less of them. You're going to own less stocks and more bonds. And that represented a very simple opportunity to rebalance back to the target stock bond mix that you might have in your portfolio. And so that's the number one thing that we did. But we're also looking at opportunities to invest in certain asset classes or securities that are perhaps selling off too much and are thus selling at prices below what they are truly worth, even in the event of a recession. And so we are selectively looking for those opportunities, and we will continue to do so as we get more data over the next few weeks in terms of what's actually happening with the economy and what companies are actually earning.
Well, a ton of research you guys do, and again, I appreciate the partnership and the time. It's Good Friday, the market's closed. You're still willing to come on this thing and meet with me. So I appreciate it so much. I know for my business partner, Mark McClavacek, and I, and the rest of Street Life Financial and all the mutual clients that we serve, I have to make sure I put up the disclosure here, of course, but I appreciate the time so much. Again, Brad Murphy, Regional Sales Director, of New England for Morningstar Investment Services. Definitely appreciate the time. I hope you and the family have a great and safe Easter weekend, and I'll let you sign off from here.
All right. Thank you very much, Aaron, for having me on. I really appreciate it and love working with you guys and look forward to talking with you again soon.